This video is sponsored by Tendies, but more on that in a bit. Hey, good morning, this is Tom, and let's talk about the inflation numbers for February. They're a lot more nuanced than mainstream media tells you. Now look, the February inflation numbers are out. The consumer price index is up 6% compared to last year and 0.4% compared to last month. Basically, all this means is that stuff are 6% more expensive this year compared to last year. So the question is, beyond the numbers, is this good or bad? Well, in general, these are good news. You see, on June 2022, we had 9% year-over-year inflation. And just in January, we had 6.4% inflation. Now we're at 6%, which is a big improvement. In fact, this is the 8th straight month of slowing inflation and the lowest inflation we had since September 2021. But it's too early to sit around the campfire and celebrate by singing Kumbaya because there's a lot of nuance here. There's a lot of bad things in this inflation report as well. Now, core inflation, which is basically the consumer price index without food and energy prices, was actually up 0.5% for the month, up to 5.5% year over year. This means that the core inflation is accelerating at the highest rate over the past 5 months. This means also that without energy prices dropping, the consumer price index reading might have been a lot less attractive, but on the other hand, if grandma had balls, she would be grandpa. So, there's that. Now, look, despite this smudge on core inflation, in general terms, inflation figures are in line with expectations. And the biggest winner here is going to be Jerome Powell because he can finally relax after the challenging few days he had with the banking collapse over the weekend. Now, don't get me wrong here. We are still at 6% inflation, which is 3 times more than normal. And if you actually look at real inflation, it's probably much, much higher than 6%. But at the very least, we seem to be declining on the CPI, the Consumer Price Index terms, for now. Now, where did this inflation slowdown came from? Well, the good news are that energy prices declined in February, but the bad news is that food prices are still rising sharply and are now 9.5% more expensive than last year. Housing costs also rising at 8% year over year. That's still very high. So with that being said, what will the Fed do with the interest rate hikes? Well, we know the Fed looks at the consumer price index to determine its policy, right? That's kind of standard stuff. But this February's report, along with tomorrow's producer price index, which will show us the inflation on raw materials and goods, should have been the key here. But this time, there's more to it than just looking at the CPI and the PPI data, the consumer price index and the producer's price index. Because look, so far this year, the Fed was very aggressive with interest rate hikes we haven't seen since the 80s. And during Fed Chair Powell's last speech, he actually said that 50 basis points increase was on the table. But all that was before the collapse of the 3 banks of the weekend. Now, there's an old saying that a hawkish Fed is going to keep raising interest rates until something breaks. So the question here would be, did something break? Did the collapse of the Silvergate Bank, the Silicon Valley Bank, and Signature Bank is breakage enough for the Fed to chill the fuck down? Well, according to the CME FedWatch tool, there's a 73% chance of a 25 basis point hike at the Fed meeting next week and a 27% probability of no hike at all. Just a week ago, markets were seeing a 70% chance for a 50 basis hike and 30% chance for a 25 basis hikes. But as I said, the collapse of the Silicon Valley Bank and Signature Bank over the weekend basically have paved the way for what seems to be the 25 basis point hike territory. It also might be 0, but it seems more likely that 25 would be it. Now, I suspect that the Fed will be a bit more dovish this month, both with the 25 basis points increase and the things that Powell will actually say. And once banking stocks recover and once the overall market fear subsides, we might see a return to a little bit more of a hawkish stance from the Fed, unless, of course, inflation data comes in super low all of a sudden and basically we have no longer an inflation problem. Now, that is, of course, more likely than grandpa having balls and becoming grandma, but again, it is what it is. Now, before I let you go, I want to tell you about today's sponsor, Tendies. Now, Tendies and I have been working for a while together. It is a free platform that will give you access to some of the best research on the internet, some of the best information in real time, which is key in this crazy volatile market. And most importantly, their options tools are some of the best in the game, and somehow they're free. They have complete options flow. They have an options calculator unrivaled by anything I've ever seen, and it is 100% free. And most importantly, you can actually link your brokerage account through their platform and get real-time data that's customized to your portfolio. It's an absolute beautiful platform which my community uses every day. The link is below so you can filter out noise, use Tendies. Thank me later. See you in the next video.